Hello, everyone, and welcome to today's webinar, Opportunities for Banks to Better Serve People with Disabilities, Mining FDIC Data. Before we get started today, I just want to go over a few logistical slides of information. Listening to the webinar, the audio for today's meeting can be accessed using computer audio or by calling in by phone. If you select computer audio, please make sure that your speakers are turned on or your headphones are plugged in. If you do not have sound capabilities on your computer, or if you prefer to listen by phone, you can dial 1-929-205-6099 and enter the meeting code 610-831-169. Real-time captioning is provided during this webinar. The captions can be found by clicking on the CC button in your Zoom controls at the bottom of the screen. If you do not see the captions after clicking the button, please alert the host, which is listed as NDI Webinars, via the chat box. You may also view captions within your browser at http://www.streamtext.net/player?event=NDI. For submitting questions, please use the Q&A box to submit any questions that you have during the webinar, and we will direct them accordingly. If your question is not answered during the webinar, or if you are listening by phone and are not yet logged in, you may email kauchenbach@ndi-inc.org. For technical assistance, if you experience any technical difficulties during the webinar, please use the chat box to send a message to the NDI host, again, which is listed as NDI Webinars, or you can email the host at kauchenbach@ndi-inc.org. Please note that this webinar is being recorded, and the materials will be placed on the National Disability Institute website, and you can find those materials under our Resources tab and then Webinars. And then a quick disclaimer, just that the views and opinions expressed in this presentation are those of the speakers and do not necessarily reflect the official policy or position of any of the government agencies or organizations mentioned. And with that, I'm going to turn it over for our welcome and introduction of today's panelists.
Thank you, Katie. This is Michael Morris, Executive Director of National Disability Institute. I appreciate so many of you joining us from across the country. This is the fifth in a monthly series of webinars for the Center for Disability Inclusive Community Development. Today, we're going to be taking on the topic of opportunities for banks to better serve people with disabilities, mining FDIC data. I'm very pleased to be able to share this time with you with two presenters, Keith Ernst, the Associate Director for Consumer Research and Examination Analytics at the Federal Deposit Insurance Corporation, FDIC. If you can go to the next slide, please. Keith has served as the Associate Director for Consumer Research at the FDIC since 2011. The role extends a career that has spanned the intersection of research, policy, and banking issues. In his present capacity, he leads a team of researchers and analysts that provides expertise to the FDIC's Compliance Supervision Program and conducts original consumer research, including what we're taking on today, very critical research on economic inclusion topics, such as the FDIC's National Survey of Unbanked and Underbanked Households. You can read further about his bio, but Keith has joined us in the past as we've been working together now for the past 6 years. This is the third in a series of collaborations utilizing this important data set made available to the public by the FDIC. So with that, let me turn to Keith, who will tell you more about FDIC and their economic inclusion research, why the FDIC does this research, and some of its history and where we are today. Keith, have you joined us?
That kind introduction. I want to thank everybody actually at the National Disability Institute for the invitation to participate today. I hope my brief presentation will make clear economic inclusion is an important priority at the FDIC. I'm really genuinely pleased for the chance to engage with and learn from NDI's analysis along with everyone else on the call. I'm going to turn to my first slide, and I'll just let the organizers know that I'm not seeing the slides on my screen, but I have confidence that other participants are. And I'll just talk to each slide in turn, though. So looking at this first slide, I think I would start out with the observation that while it seems almost self-evident, it's nonetheless worth observing that a banking system that is inclusive, that treats consumers fairly and serves a broad set of needs is one that enhances consumer confidence. Inclusive practices can also help banks meet their obligation to address the convenience and needs of their communities, including among low and moderate income households. I think, with these thoughts in mind, it's always seemed natural to me that the FDIC would invest in research that can help inform efforts to expand consumers' access and sustainable use of banks. In some ways, I think the FDIC is uniquely positioned to help identify the research that can yield information that will be useful to a wide range of stakeholders, whether that's financial institutions themselves, community-based organizations that are so often critical partners to those institutions, journalists, a wide range of public officials. Many people really have an interest in this topic, and so it's a role we take on more than willingly. And in fact, this motivation has resulted in a fairly diverse array of FDIC research projects, both focused on questions relating to consumers and on questions relating to financial institutions. And these projects have drawn on a wide range of approaches, from qualitative methods like focus groups and in-depth interviews to empirical research, including survey research of the sort we're gathered to talk about here today. And moving to the next slide, I guess I would say the research being presented today really does build off of the empirical survey research that the FDIC regularly conducts in partnership with the United States Census. The FDIC National Survey of Unbanked and Underbanked Households has become a key reference, and I think that's really for three reasons. First, the information collection itself is of very high quality. It's developed by a professional team of economists, analysts, and experts who work diligently to ensure that the survey uses the best methods. Just for example, to help people understand this process, each question on the survey is subjected to field testing to ensure that they're presented in ways that make sense to respondents from a variety of backgrounds. Equally importantly, on the back end, professional census survey administrators are provided specific training and a range of supports to help ensure high quality data collection. That collection itself happens in person and on the telephone, and that helps us avoid some of the challenges associated with other survey methods. So I think the first reason the survey sort of becomes so relied upon is just the quality that of the information that's produced because of these sorts of measures. But second, I think the large-scale nature of the survey itself gives rise to a substantial data set that can be useful for understanding not just national results, but differences across geographies and for different population segments. Obviously, today we're focused on the experiences of individuals with disabilities, and the survey, because of its size in part, can support that kind of examination. And third, I think the survey has taken off because its content has proven relevant and informative. So that's a bit of background on the survey itself. going to go to the next slide and just talk a little bit about some of the measurements included in the survey. The survey measures inclusion in the banking system through two primary metrics. First, and sort of most central to the questionnaire, is it asks whether anyone in the household has a checking or savings account at an insured institution. Having a bank account is foundational. It's a primary mechanism through which households establish a banking relationship where they can securely receive and store money, make payments, and access a broad range of financial products and services. Households where no one has an account are categorized as unbanked. This measurement is complemented by a second metric that assesses whether households with bank accounts nevertheless turn outside the banking system to meet some of their needs during the year. Specifically, we ask whether households turn to non-bank alternative financial services providers for one of 3 transaction services or 5 credit products. Examples would include consumer use of non-bank check cashers or borrowing from pawn shops. In asking this question about when bank customers are turning outside the banking system, we're really asking about the opportunity for banks to address additional customer needs. We've identified other opportunities to assess related questions, such as the extent to which customers are accessing credit that will support the establishment and maintenance of a credit score, or along a very different line about the variety of channels or methods, such as online or bank tellers, that consumers are using to access their accounts. But what all of these measurements have in common is that they can provide insights into consumers' needs and preferences and into opportunities for banks to respond to these signals. Moving to the next slide, I want to observe that the survey itself is not static. Over time, the FDIC survey team has really looked for opportunities to make revisions that improve the survey and help it better accomplish its purposes. Some of the changes that we've instituted have in fact not even been identified by FDIC researchers, but by external survey users. For example, the very topic we're discussing today, the experiences of individuals with disabilities, was initially brought to us by an advocate. This suggestion led us to investigate how we might be able to take on the challenge, to consultations with outside experts like the National Disability Institute, and eventually to the formulation that we have available to draw on here today. And that's really a good reminder that another positive aspect of having a survey like this administered by a public agency like the FDIC is that we follow a process that requires us to publish our survey questionnaire and invite members of the public to suggest improvements, which we consider and respond to before finalizing our instrument. So in some ways, this really, even though the FDIC sponsors and help shape this survey, it's a public survey instrument, and we are in some ways a caretaker of it. So while we've not yet received the 2019 survey data, the Census Bureau has already administered the survey, and we look forward to analyzing and sharing results in the coming year. While obviously I can't talk about results, I can talk about some of the changes in the instrument that we're looking forward to learning from. So first, the revised instrument asked households to provide an indication of how often they turn to non-bank alternative financial service providers. In the past, we've been justifiably asked whether someone who may use an alternative financial service once in a year should really be taken as a meaningful indication of an opportunity for banks to address additional needs. While previous work has suggested to us that many consumers, in fact, are regularly using alternative financial services, adding the questions that we have will give us the ability to capture information that will let us describe that with more precision and give us deeper insights into the needs of the underbanked population. So when we deliver the new results, we'll be able to bring that information to the table as well. We've also included a question to try to understand more about consumers' overall satisfaction with their banking relationships. And this is potentially quite useful because the present survey provides us with relatively limited information about the experiences of banked households. We do know, for example, consistently across our surveys that about half of all unbanked households have previously had a bank account. So we understand that consumers are at times exiting the banking system, but in terms of customers who are currently in the banking system, we don't have many questions that help us understand whether various population segments or consumers in different regions of the country are having, to what extent they're finding those relationships to be different in terms of their overall satisfaction. This question will give us the ability to explore that topic. And finally, we've made a number of changes to improve the flow and brevity of the instrument. Experience shows that these changes can lead to stronger data quality and improved response rates, and so we certainly want to support those ends as well. Moving to the next slide, I've already made some of the points in this slide, but I'd like to take just a minute to talk about the nature of the contribution a survey like this can make. And I would say for many on this call, I suspect that some of the results that come out of the survey are consistent with your perceptions from work you do directly with customers, members, constituents, or clients, or perhaps from your own lived experience. If your experience is like my own, the survey may sometimes produce unexpected results, and those are interesting. But just as often, it may prove interesting and useful because it gives substance to perceptions we can articulate but not describe with specificity. It provides an authoritative set of measurements that describe the experience of consumers in the marketplace and provides us with a common basis with which to engage in a conversation about opportunities to improve those experiences. And I think that in of itself is inherently very valuable, and of course all the more valuable when more people are coming to the data, making use of it, and analyzing it to ask questions relevant to their own expertise, much as we're doing today. And I guess that would take me really to the last slide of my presentation, introducing sort of this survey to this audience. And that's a slide that shows where you can find and access our information directly yourselves. Over the years, we've enhanced our capabilities on this website, economicinclusion.gov. Users can find resources that will allow them to generate tables or even figures that are based on a query that the website will help you design and administer to our underlying data. More advanced users can download the data and full documentation to bring into their own environment to work with and analyze. And you'll also be able to access all of our reports from the years that we've been conducting the survey, as well as some of our other reports based on different methods. And I certainly wanted to make sure this audience had access and was aware of those materials. And I think, with that, I'm going to hand the floor back over, become, like everybody else, a really interested audience member to hear the rest of this presentation, and we'll look forward to joining in the question and answer period.
Keith, thank you so much for framing this out. I don't consider myself a researcher. I work with Nanette and other researchers, but it's great to understand the context for both the collection of data and the continuing partnership with Census that FDIC brings forward this data. And I think most important to all of us is the fact that this is a public data set, and NDI researchers, university researchers, researchers at financial institutions and other places have the opportunity to dig down deeper and really isolate particular data that begins to create very rich pictures of financial status and financial behavior of particular segments of the overall U.S. population. And that is what National Disability Institute has been doing and we are very grateful for your cooperation and FDIC making this data available, which really has provided, as we go back 6 years and go forward and look forward again to the data that will come available next year in terms of the 2019 survey, to continue to get not only a point in time, but also more of a longitudinal historical look at, for us, households being led by people with disabilities, the opportunity to see trend lines. Are things improving? Are they staying the same? And in some cases, unfortunately, are some things getting worse? Which to us is all about taking that information, those findings, and looking to, again, collaboration in both the public and private sector, financial institutions, community nonprofits, and others, to craft, design, test, evaluate different types of interventions. So, Keith, thank you, and thank the others at FDIC who worked so hard on this and continue to bring this data and this information forward. Nanette Goodman is the research director at the National Disability Institute, and she leads our efforts to provide foundational research on the financial health and security of people with disabilities. She has produced 4 major reports that quantify the disparities between people with and without disabilities in their financial stability and use of financial services. She has also led with others a series of focus groups to understand the challenges this population, people with disabilities across the full spectrum of types of disability, face in accessing financial services. In addition, she evaluates the impact and the efficacy of financial empowerment programs that NDI and others have been fortunate to begin to pilot, to design improvements, and continue to try to build a roadmap for greater financial stability, greater financial health and well-being for people with disabilities and their families. So I'm going to turn it over next to Nanette, who can pick up from where Keith took us in terms of how do we use this FDIC data, what other complementary research have we been able to explore, and then most important for all of us who've joined today on this call is what have we learned? And then I will attempt to bring us to, well, based on what we have learned, what are some possible opportunities for collaborative activity, collaborative action, which can continue to advance better financial health and well-being for people with disabilities. So Nanette, let me turn to you and share with us what you did and what we've learned.
Okay, thanks, Michael, and thanks, Keith, for teeing this up so well. But I want to start just saying on a very personal level, this is such a rich survey. It is a blast to work with. So I'm really glad to be able to be sharing the results that we found with you. But because the survey includes a lot of questions about socioeconomic and demographic characteristics, including a set of disability questions, which I'm going to talk about in a minute, we were able to use the survey to compare the experience of working-age households with a disability to those without a disability. First, we disaggregated by disability and socioeconomic characteristics. We also compared the results from previous years, but we didn't want another report that just said people with disabilities do this. But we want to make the assumption that people with disabilities are making rational decisions with the information they have. So the disparities we highlight should lead us to ask, what can banks do to better serve this population, and are people with disabilities armed with the right information to make the best choices that are available? So how do we go from the data to some deeper understanding of what's going on? We conducted a series of 7 focus groups with a cross-section of disability types, race, income, education, and employment status, a total of 56 people. Each group was hosted by a different organization, including a few nonprofits, a few advocacy groups, and others. And we posed questions that sort of aligned with some of the FDIC questions. We used a formal focus group research approach. We recorded the sessions, we transcribed, and we coded them. And at this point, I should give out a shout out to Bonnie O'Day, PhD, who I consider a qualitative researcher extraordinaire, who helped lead us in the focus group effort. So let me talk a little bit about identifying disability in the survey. So first of all, what do we mean by the term disability? Disability describes a really wide range of individuals, and the lived experience of disability varies across all these different components. The term disability generally describes a group of people of between 40 and 57 million adults who have a physical, mental, sensory, or psychological condition that somehow limits their activities. But for our purposes, I think it's really important to note that a person's disability can be related to vision, hearing, movement, communication, cognition, or psychosocial issues. It can range from mild to severe. It can be constant or episodic. It can occur at birth, in old age, or anywhere in between. It can arise from a chronic illness, injury, or aging, or it can be congenital. People with disabilities vary by age, income, education level, race, ethnicity, and other socioeconomic characteristics. And I want to point out this diversity because the diversity in the types and severity and the age of onset and the relationship between income and race has really significant implications for developing strategies to promote financial inclusion. And as we look at the data, we need to recognize sort of all those different components. What we find is that, actually that's the next one. So how do we define disability in our survey, given that it's kind of a complex idea? The FDIC survey, along with a lot of large national surveys, use a set of 6 questions to identify disability. They ask about hearing. Are you deaf or have serious difficulty hearing? They ask about seeing, cognition, ambulatory challenges, self-care, and difficulty doing errands alone. There's also a question on the survey about are you working? Actually, it's a whole series of questions. I shouldn't limit it. It's like a huge series of questions. But basically, you can pull out of that people who are not working because of a health condition or disability. So how do we talk about households with a disability given the survey questions? So we talk about a household with a disability to indicate the householder has one of those 7 conditions, said yes to one of those 7 questions that I just mentioned, and they're between ages 25 and 64. The idea of a head of household versus a householder is a little complicated. We used to think of people as heads of household, but we now understand that there's no such thing as a head of household because so many decisions are really jointly made. So a householder is pretty much the person who is on the lease that is the first person to answer the survey. But what we've done for this survey is sort of, for our analysis, is remain consistent with the FDIC analysis in how we define whether the householder and the household has a disability. What we know is that disability exists in households across the economic spectrum, but, and this is really important, households with a disability are disproportionately lower income. They are more likely to be older, even among the working age population. They're more likely to be in that 50 to 64 category than in the 18 to 25 category. And they also tend to have lower levels of education. So with that background, it's time for tables. So let's dive into the data. So when we look at the banking status of people with disabilities, we've already talked a little bit about what unbanked and underbanked means, but what we find is that households with a disability were 3 times as likely to be unbanked as households with no disability, 18% versus 6%. That means no one in the household had a checking or savings account. That's almost 1 in 5 households. That's huge. And then we have another 25% of households that have a bank account but used an alternative financial service like money orders, check cashing, or alternative financial services for credit like payday loans, tax refund anticipation loans, and things like that. And we think that they use those services either because the bank doesn't offer the service they need, the bank offers it, but the household doesn't qualify for it, or especially in the case of money orders, it's offered elsewhere at a lower price or with more convenience. The other thing that we find is that we use some statistical techniques, and we found that even when we control for those other characteristics, households with a disability were less banked than those without disabilities. So, for instance, we know that low-income households are less likely to be banked than higher-income households, but even among low-income households, households with a disability were even more likely to be unbanked. But the other thing that we realized is it's kind of a fool's errand to try to tease out what part of this disparity is because of disability itself and what part is caused by other characteristics, because if it's caused by low income, well, low income is caused by lack of employment, which can also be related to disability status. So it's very difficult to tease out, and probably not useful to tease out, what's socioeconomic characteristics and what's disability. But we did it anyway, and we found that disability does have a significant impact. So then what we did is we looked at that unbanked rate over time. On the next slide, there we go. And what we find is that the disparity in banking status between households with and without a disability has actually increased over time. The unbanked rate has been declining slowly for households without a disability, but has been sort of stubbornly stable for households with a disability. And what that, while we had an 11.5 percentage point gap in 2011, that has grown to 12.4 percentage points in 2017. It's not a huge difference, but the fact that the unbanked rate is going down steadily for those without a disability and not really moving for those with a disability is highly concerning to us. So we want to know why are people unbanked? And the FDIC survey asked unbanked respondents to identify all the reasons they're unbanked. There's also a question about what's your primary reason, but for this we want to look at sort of all the reasons. And the main reason, not surprising, is people say they don't have enough money to keep in an account. But even among unbanked households, that was people with disabilities were more likely to say that. So they're more likely to say they don't have enough money to keep in an account, but slightly less likely to say they're unbanked because they don't trust banks or because avoiding banks provide more privacy. And something I want to point out here is that a quarter of unbanked households, both with and without a disability, say they're unbanked because account fees are too high or unpredictable. And I want to point this out because it's going to come up in several different contexts over the course of my presentation. And now I want to turn to our focus groups, who gave us some interesting reasons about why they're underbanked. I have to admit that in our 56 people, we didn't find a lot of people. We didn't find a lot of people who were unbanked, but we found a lot of people who had bank accounts but still turned to alternative financial services. So many focus group participants expressed anger and frustration about account fees, ATM fees, and especially overdraft fees. And as a result, they used check cashing services and non-bank money orders to avoid the bank fees. So they were willing to go outside the bank and pay a little bit more to avoid the unpredictability of the bank fees. A particular problem for low-income focus groups participants was the time it took for a check to clear at the bank and for the funds to become available. And what would happen is they would get a check, they would try to withdraw based on that check, but the check hadn't cleared, so they would end up with an overdraft fee. And the thing that really surprised me is that at my first focus group, a woman explained to me that if you write 3 checks the same day, the bank will process the largest check first, thereby maximizing the overdraft fees. And I thought, oh my gosh, these people know so much about the banking system. People are not walking through blindly in this system. They're very aware of what's going on. They talked about using check cashing services to get immediate access to their cash without waiting for the bank to clear the check, because it's known. They used non-bank money orders so that they could budget better, but also because the money was taken out immediately, there were no pending charges. They didn't have to worry about a recipient holding the check and then cashing it later. And others also wanted immediate proof that a bill had been paid. So I have to say that some people felt unwelcome by their bank, and as a result turned to services that made them feel more welcome. Many described sort of negative experience that they believe were due to their income or their disability. One person said, it's like there's judgment going on. It's like they say, why do you get Social Security? It's been really hard. I worked my whole life and I had to go on disability. They think we just kick back and don't do anything, but it's really hard. Somebody else said, some banks I don't go to anymore. I've had a bad experience because sometimes banks don't want to deal with people with learning disabilities, so they push you aside. So what we found is our focus group participants changed banks, they shopped around, and they used alternative financial services. I was actually a little surprised about a lot of focus group participants really talked about traveling some distance to go to a bank branch where they actually felt welcome. So let's talk a little bit about the primary methods they use to access bank accounts, and now we're back to the FDIC data. So what we find is that people with disabilities are much more likely to use the bank teller and less likely to use online and mobile options as their primary method to access their account. This is really concerning as banks are moving toward more online services. We really need to watch out for this disparity. And I have to say, I haven't stepped foot in a bank in years. I do everything online, and I get my cash when I go to the grocery store. So I was really interested in hearing why people went to their bank branches. And I have to say, Michael's probably looking at me going, I go to the bank. But anyway, several of them said the equivalent of, I just like doing it the old-fashioned way. But others mentioned, so I talked a lot about sort of the negative experiences that people had at banks, but people do have positive experience as well. And several participants mentioned how important it was to develop a relationship with somebody at the bank branch. So if a problem arose, they would have somebody to turn to. And I have to tell you that the main reason they turned to this personal relationship was to deal with these overdraft fees. They talked about how, well, if I go talk to my friend, maybe they'll reduce one of the overdraft fees, and then I only have to pay one or two. You know, some people with intellectual disabilities talked really nicely about how, you know, they'll sit me down and they'll help me understand where to put my money and how to manage it. They make me feel important. They help me write down what I earned and how to budget. Somebody who was blind said, I go into the bank because I need to get cash, and they'll separate my cash into different envelopes for me. So there were these really positive experiences, and again, people traveled to get these positive experiences. I have to say, but for every good story about bank branches, there were situations that weren't so good. Like the blind woman who went into a branch to ask about a mortgage. She went in with a friend, and rather than speaking directly to her, the staff member spoke about her to her friend and said, oh yeah, the loan officer will call you. But they never did. She went to a different bank. We heard a lot about bank branches from blind focus group members who couldn't believe that banks changed to touch screens. When they had a tactile ability to type in a code, they could do it independently. But with a touch screen, they needed help. And sometimes some banks still had a keypad in sort of one place that the person could go to, but still they were definitely frustrated about accessibility. Wheelchair users talked about the height of the teller windows. It's like talking to a wall, they said. And one of the most interesting things to me was a deaf focus group participant said, it's an attitude. They should understand our culture. If they have paper, we can write notes. But they just say, oh, you can't hear. They show us this expression. It's so obvious. It's the deer in headlights look, he said. Or they assume we can all read lips. We can't. Another told a story about a bank loan officer who was working with the guy on a mortgage, and at the end, you know, and as they were about to finalize the mortgage, the guy handed him the paperwork and said, here, go ahead and sign this. And the guy said to us in sign language through an interpreter, he handed me a document, a legal document that is essentially in my second language, and expected me to sign it immediately. And I was like, oh. So that's, you know, so each type of disability is facing different types of barriers and different types of challenges at the bank branch. Now we can talk a little bit about online and mobile technology. And people with disabilities are less likely to use online or mobile banking services. And some of this disparity is because people with disabilities are less likely to have access to internet and smartphones. However, even among those with access, people with disabilities are less likely than people without to use the services. And this disparity in access to the technology has actually been decreasing since 2013. So that's good news. But the question is, why aren't people with disabilities using it if they have access to it? So again, we asked our focus groups, and they sort of revealed both the promise and the barriers to smartphone and internet-based banking. They talked about how the technologies can ease the burden and the expense of physically getting to the bank. One person said, wheelchair user said, who's got time for that? But despite the benefits, participants vary dramatically. People who were blind talked about how great it is that they can have alerts that gave them their daily balance through email. They don't have to deal with reading paper statements. I recently had a problem with my account, and I was able to speak to a person pretty quickly. So that's sort of on the positive side. But on the other side, several blind participants talked about bank websites being difficult to navigate, even with their screen reader. In some cases, the web developers didn't insert alt text, or they've added too many graphics that aren't accessible to people who are blind. One blind man put it in a nutshell when he said, for him, it's not easy to access them. And when the website changes, you have to learn it all over again. It's a learning process that can be really time-consuming. And some focus group participants talked about how actually cell phones, mobile apps, are a little more accessible than online apps because they tend to be a little more linear and you're not jumping across the screen. So that's sort of what we learned about access to, about why people are using online and mobile technologies. There's a couple other things. We did learn a little bit about ATMs on the next slide. You know, people talk about how they're convenient, very convenient, but some people especially felt that the outdoor ATMs were unsafe. They felt unsafe at outside ATMs, with the idea that, you know, if people without disabilities are getting held up, oh my God, what's going to happen to me? But the thing that we heard the most about was the automated phone. And a lot of people are using the automated phone to check their balances, to make sure nothing's coming out that shouldn't be. They just find it easier to do on the phone than online. But we did one focus group with a group of deaf participants, and they expressed a significant level of frustration about calling their bank. The newest technology of communicating via phone is a video relay service where you have somebody signing, and the deaf person can see the signer, and the bank can talk to the signer. But banks will sometimes mistakenly believe they can't communicate confidential information through this technology. This has already been litigated, but the focus group participants still were experiencing it and were very angry, really felt like they were being, for lack of a better word, dissed. So what do we know about the use of alternative financial services? So we know that people with disabilities are more likely than their peers without disabilities to use alternative financial services. A third have used some sort of alternative financial service compared to 23% of those without disabilities. So the transaction and 28% use transaction AFS compared to 19% of those without disabilities. And a lot of the transaction AFS is really those money orders that we talked about earlier that allow people to have a guaranteed form of payment. While money orders can be issued by banks, they're usually sold for lower cost at post offices, grocery stores, or convenience stores. And that's a big reason for people to be underbanked. And I think, we really need to address the question of, is it a bad thing if people are using AFS for something that's lower cost somewhere else? But it certainly is an opportunity for banks to fill a gap. And like I mentioned earlier, the other part of the transaction AFS is the check cashing services. But they're also more likely to use credit alternative financial services, 12% of people with disabilities versus 7% of people without disabilities. And we'll get back to talking about credit after we talk about savings. So what we find is that people with disabilities are less likely to save for unexpected expenses. 33% of households with a disability and 63% of households with no disability save for unexpected expenses or emergencies in the last 12 months. And this is true regardless of their income level, although people with lower income are certainly less likely to save. People with disabilities in each income level are less likely than their peers, than their similarly situated peers. So focus groups cited two primary reasons for their lack of savings. Either they didn't have money, or they were worried about saving because it would put their Social Security benefits, especially their SSI benefits and other means-tested benefits, at risk. And even when they did save, households with a disability were less likely to use a savings account and more likely to keep their savings at home with family and friends. So one person said, I don't have anything to save. Just to open an account at my bank, you needed $500. Where is someone on disability benefits going to get that? Somebody else said, I was a homemaker, and when I became disabled and stopped working, I didn't have enough money to keep a savings account. There was just no money. It became very tough for me. Approaching 50 years old with no money, I just didn't have any. And, the second one really talks about that issue of people who have the onset of a disability as they get a little older and they've had income, and then all of a sudden they have to adjust their employment, and their income may very often plummet. So people talked a lot about their fear of losing Social Security benefits if they saved. And some of this talk was a rational concern in response to Social Security policy. In other cases, it was based on a misunderstanding of how the policy affected them. And still others, it was based on kind of an irrational reaction to the possibility of unpredictable SSA actions. But what we came around thinking is that people are terrified of SSA. And even if they can save, they're not saving because of this concern. And I have to say these focus groups were done before ABLE accounts became widely available. So at the time, there was nobody in our focus groups that had ABLE accounts. But hopefully, if we did them today, we would find people with ABLE accounts to get around to address this issue. So now let's go back to our mainstream credit. Go back to credit. So what we find is that people with disabilities are less likely to have any form of credit. Credit cards, store credit, mortgages, auto loans, student loans. And when we talk to our focus group participants, what we found is that many didn't want credit cards or loans because they were concerned that it would be too difficult to pay off because they had either low or unpredictable incomes. And for some, low credit scores prevented them from getting access to credit. And here again, we run into this problem where, people describe this situation where they took out a loan prior to the onset of their disability. They had the onset of a disability, they couldn't pay off their loan, and now their credit score is in the toilet. And that's pretty much how they talked about it. One guy said, I love this, that he went to the bank. The representative said, well, if someone could only get you a full-time job or a part-time job that pays good money and you could get the payments, we could set you up with a loan for $5,000 and you could get rid of the credit card and just make one payment per month. And the participant said, if I could get a job, I wouldn't be in this situation. So the question is, when we look at the unmet need for the credit, the next slide, so the question is, when we look at this data about credit, we need to ask the question of how much of this lack of credit is by choice and how much of it is because people can't get the credit they need. And in the survey, the answer is a little bit of both. In the survey, 19% of households said they either applied for bank credit and were denied, they would like to apply for credit, but they were discouraged, probably because they didn't think they could get the credit, or they used non-bank credit. It's an indication that there is this unmet need for credit. It's not everybody that doesn't have credit, but there is a significant unmet need for credit among people with disabilities. But then there's something even more troubling on the next slide. In 2015, 47% of people with disabilities had no mainstream credit, and this has been reduced to 40% in the newer survey. But for people without disabilities, there's even a larger reduction. So the disability gap has actually grown. So what we're finding is that, as the economy recovered over this time period, everybody benefited, but people with disabilities probably benefited less, and that's coming out in their access to credit. So now we're going to turn to Michael about what this all means.
Thank you, Nanette. And that's a lot of data. That's a lot of findings, a lot to take in. But fundamentally, we're seeing, unfortunately, trends where, whether it's access to credit or greater use of banking financial services, if things have gotten better, they haven't gotten better at the same rate as people without disabilities. So my challenge was to take Nanette's findings and think about ways, what can we do? What is possible at a more systemic level? And I'd have to start off by saying there are things we can do. There are opportunities for the banking and disability community to work together. And clearly, what we're beginning to see are a variety of pilot projects, demonstrations, and I think certainly on the very positive side over the last 6 years, there has been much greater interest by financial regulators, FDIC, Office of Control of the Currency, and the Federal Reserve, in really looking at what are the financial behaviors, financial challenges of people with disabilities, and talking more about what can regulated financial institutions do to be responsive. I wish I could tell you that there is just one magic bullet, as they might say, or magic single solution. There isn't. But there are things that can be done, and I want to share some of my thoughts and recommendations with you. And whether you're a member of the disability community or you're listening in representing a financial institution or a bank regulator, or another public agency, I hope you will listen to these recommendations and think about it from a standpoint from what I do within a public agency, as a regulator, as a banker, as a agency that's providing supports to people with disabilities. What could I do? So the first area to share with you is about access. How can we draw more customers into mainstream financial services? I think what we've learned from the FDIC surveys and the focus group research, which continues, is that there is more opportunity to find what I would call teachable moments. So many channels exist that involve different federal funding that flows to states, sometimes flows down to cities or other agencies, public agencies like the vocational rehabilitation system, public agencies like the many community nonprofits who may be providing services through home and community-based Medicaid waivers, and even school systems at a local community level. I think all of us have to think more about teachable moments where publicly funded dollars flow and eventually reach that child, that adult, that youth in transition, that family who may be receiving supports from some publicly funded system. Those teachable moments could be when a child is having their individual education plan put together, that it not only look at education objectives, but we also look really beginning even as young as children in elementary school, but also at the secondary school level, is what are the teachable moments and what objectives could we add to an individual education plan to build the skills, the knowledge and skills of children and youth in transition with disabilities to become more competent in making informed financial decisions, more competent in understanding the use of money, the use of bank accounts, the use effectively of financial services, and the difference between financial services and alternative financial services, which typically can cost more money. We also know that another part of access is to continue to build trust and transcend compliance issues for banks, whether it's ADA related or some other rules, to think about superior customer service. Superior customer service, as we're learning from financial inclusion summits that we have done all across the country in some 50 different cities, which brings people with disabilities together, organizations providing support to people with disabilities, and the banking community. What people with disabilities and organizations working with them are telling us is engage people with disabilities to be part of sensitivity training for banks, the frontline bank staff. They also have said to us they'd love to see more people with disabilities employed on the front line when they go in to a physical branch of a bank, to feel more comfortable that there are people like us here who maybe have even personal experience that they can translate to provide superior customer service. A second area is sustainability. How can we keep individuals with disabilities who have opened accounts to stay in the banking system? Some of the statistics that Nanette presented were about people being a part of the banking system, but still using all too regularly alternative financial services. And an area that National Disability Institute began working on some 2 years ago, but culminated in the opening of a new center on disability inclusive community development, which is helping bring forward this webinar today, is to look at how the CRA, the Community Reinvestment Act, which has requirements for banks to look at ways they can improve investment, lending, and services to low-income people, including people with disabilities, that it opens up yet another arena of focus for the regulators of banks, the bank examiners, to be asking additional questions, when we know that low-income people with disabilities living in the physical footprint of banks, from our own mapping and great research that Nanette is leading, we know people with disabilities are in those low-income neighborhoods, but have not really been a target and focus of CRA investment, lending, and service activities to the degree that perhaps they could be if we looked at the percentage of people of low income with disabilities within that physical footprint. So it means some new kinds of conversations, expanded and extended relationship partnerships between community organizations and disability-related nonprofits, whether it relates to affordable and accessible housing, or it relates to workforce development, or it simply relates to support of financial education and counseling. This is a ripe opportunity for keeping people with disabilities who have come into the banking system to understand more of how banks are going to be responsive to their needs. The third area is the area of growth, deepening banking relationships and fostering financial empowerment. Nanette shared with us statistics about use of internet and software as more financial services are being accessed online. We still believe, despite the trend not quite there yet, that this is a ripe opportunity for ways banks can improve financial services responsive and reflective of needs of individuals with disabilities. As more financial fintech apps are developed both by banks and others, or banks in partnership with fintech companies, let's not forget the potential of advancing economic inclusion. And that, of course, means as well that those apps and mobile financial services need to be both affordable and accessible. And then, as a third and final point, we need to revisit the definition and oversight of financial inclusion. What does that mean? Since the last FDIC survey, we see the continued evolution of financial services by financial technology companies. A wide range of new products and services continue to be offered to consumers that challenge traditional thinking and behavior with new access points, different approaches to credit, alternative methods to save and invest, and varied choices in how one makes payments or transfer funds. FinTech offers significant opportunities to advance financial inclusion by providing new opportunities of access to financial products and services. Banks continue to, I read almost every week, new partnerships being formed, sometimes with very enterprising entrepreneurs, brand new companies, but also big tech companies as they look at ways to improve access to financial services. The new partnerships of the next few years will involve major banks with big tech companies like Google and Amazon and others. And all of that conversation needs to keep in very much in focus what might be ways we can draw in and hold and offer alternative ways of credit, savings, other ways to embrace needs by low income and others with disabilities that truly changes and opens up ways to improve financial inclusion. So some thoughts to think about. I want to turn quickly to questions, and we have started with some questions that we had pre-prepared, but we're going to also take questions which have come into the chat box. Keith, I'm going to go to you first and start off with, as we have already said, FDIC, working with Census Bureau, every 2 years, you not only update what we know about unbanked and underbanked households, but you also have added some new questions, as you shared with us, in 2019. When you look at this past 6-year period, what are some important trends you see that you could share with our audience? Keith, are you there?
Hello?
Yep, I think you're there now.
Great. Thank you. Yeah, I'm glad to respond to that question. Maybe before I do, just very briefly, because I really enjoyed the content in this webinar, I wanted to just offer one observation consistent with a lot of the information that Nanette shared and that you've sort of discussed in the call here. And it's a really sort of, I think, worthwhile observation to think about not just that financial inclusion is not just about the connection to banks, but that what our research has shown us, what I think some of the results you've shared with today, is thinking about connections that help consumers access and use financial services that are good fits for their lives and needs. And just, along these lines, some of the points that Nanette was making about respondents saying that they had challenges with fees being too high or unpredictable. I think the challenge for consumers is being connected with accounts that are structured in ways that may minimize some of those risks. And there are increasingly different choices in the marketplace, and I think it underscores sort of, the importance of understanding both what issues are confronting consumers and thinking, as you all have suggested, about what the research suggests for solutions that may work. So I wanted to offer sort of that quick additional thought in response to all the good information you brought to the table. But just briefly in response to your question, many of the trends we've seen over the 6 years are actually covered somewhat.
But I think people with developmental disabilities come out in the, clearly are considered to have a disability by the survey. And we did do focus groups with a large number of people with developmental disabilities and sort of got some perspectives about sort of additional needs and the ways that banks were and were not addressing those needs. Like one person was like, yeah, I walk in there and they run the other way, while, somebody else is like, that they will sit down and work with me. And I think that's where we get to this issue of, is that an issue about training or is that an issue about the culture? I don't know that you can train somebody into sort of looking at people individually and addressing their needs.
And I would add to that I know in work National Disability Institute has done and continues to do, we continue to develop financial education and training that has targeted different segments of the disability community. We have a wonderful program that has focused in working with Special Olympics and focused on people with developmental disabilities and intellectual disabilities. We continue to work with Special Olympics on trying to broaden out how many of their many athletes and participants might get training related to making financial decisions, understanding money and the importance of savings and what is credit, all those kinds of things. So that's something we're doing. We also have another project that has targeted people who are deaf and hard of hearing and working with the deaf community in multiple cities on figuring out ways we can increase their understanding and awareness of the importance of financial inclusion, and working with banks to improve services for people who are deaf or hard of hearing. So that's in the mix. I'll also share that a question that came from the audience is, what programs do we have from the disability community that's going to a bank at the very top level and getting banks to do more around accessibility issues? And I would tell you that something I've seen over the last 6 years, and this isn't just the largest banks, the JP Morgan Chase and Bank of America and Citibank and Wells Fargo, but regional banks as well, not just the top four, have in many cases identified a lead staff person, and some banks have actually developed entire internal teams on issues of accessibility. The issues of accessibility, I'm pleased to say, is not just meeting compliance with ADA, but also going beyond it. I think we have Keith back.
Yes, we do have Keith back. So you can go ahead and ask Keith the question again.
Keith, are you there?
I am here.
Okay. Do you want to try that first question? What are some of the trends you've seen over the past 6 years?
Sure. I think some of the things we've seen over the last 6 years has been, first of all, overall, a decrease in the unbanked rate. 6 years ago, that rate for the nation as a whole stood at 7.7%. That's down to 6.5% in our latest survey. Now, obviously, as we've talked about on this call, not everybody has equally benefited from those trends, but that is sort of one remarkable fact. And and it's also true that there are other population segments that have had higher unbanked rates in recent years, including communities of color that have experienced larger drops in unbanked rates as well. So those have been trends at the general level that have stood out. Continued growth in use of mobile banking options. 6 years ago, that was at 23%, up to 40% in our most recent survey. I think what's notable is even as that has grown, we've seen consistently high numbers on use of bank branches for accessing accounts. It's certainly not just people in the focus groups that Annette ran that are expressing preferences for branch use. We see substantial evidence in our data that consumers do continue to use bank branches. The way they use them and the things they use them for may be changing, but even as the mobile channel has grown, we continue to see evidence of the importance and relevance of bank branches to customers' use of their bank accounts. And lastly, I think a trend that is stood out, or a set of measurements that we've been able to bring to light that I think has been quite interesting, has been the measurements around credit history consistent with having a credit score. And overall, 1 in 5 households have a credit history not consistent with having a credit score, which really can pose challenges for accessing credit when and if the needs arise. And that number is obviously higher for households headed by individuals with a disability, but that I think has been a striking finding in recent years as well.
Great, thanks, Keith. We got a question from the audience. It's a good question. Do ABLE savings accounts count as a banking service? And ABLE stands for Achieving Better Life Experience. It's a tax-advantaged savings account that has been in place now through state treasurer's offices in over 40 states. There are about 50,000 accounts that have been opened and over $250 million under investment and growing. But I'm going to ask Keith the question too. I would say it's a great lead-in to people managing money. For the most part, they're investment accounts, although many states have also offered a checking account for more day-to-day or regular transactional use. I think, to me, what's great about it is there are many things one could point out, but it's creating a savings behavior, and not just for the individual, the account owner with a disability, but for others to think of the importance of people learning and improving their financial literacy skills, money management skills. But Keith, would you technically declare it it would not count, I think, in your surveys as someone being banked?
I think there are instances where able accounts I would expect a respondent would identify an able account in ways that would count it as being included. We certainly wouldn't be able to break out those accounts separately through our survey instrument. So if somebody's accessing an able account with check writing privileges, they may report that as a checking account through our survey, but we wouldn't be able to know based on the questionnaire we have that is in fact an able account.
Right. Thank you. Nanette, I'm going to go to you. Access to credit is a systemic problem for low-income individuals, and certainly may be, and we've seen even more of a problem for low-income individuals with disabilities, relying all too often on alternative financial services. Do you have some suggestions of what banks could do to change this picture?
So I think there's the issue of small dollar loans that are generally not available through banks, and the other issue is about how credit scores are computed. There's a lot of movement to change this situation, but right now, low-income folks who are paying off their cell phone bills every month and their cable bills and are paying rent, none of those things get counted toward a good credit score. Whereas if they default on any of those things, it goes right in that credit score to reduce the credit score. So there's a lot of ways in terms of computing credit scores that could increase the credit scores for low-income people who have the ability to pay back loans but don't have the credit score to show it.
Thanks, Nanette. We had another kind of a comment and question that came in from the audience. Person first makes the comment, I strongly believe targeted training for financial institution employees is crucial. But please remember there's often a lot of turnover in frontline staff in financial institutions, so that it's important that not only frontline staff continue to get changed, and that there is a system of training. And I believe I really have seen in recent years more banks have made this a part of their diversity and inclusion efforts, not only in employment, but also in making sure that this is an area for disability sensitivity training. As we pointed out, and we've learned from our summits across the country, people with disabilities want to be a part of that training. And people with different types of disabilities, representing the diversity of disability, would like to be a part of that training. And I know now that some banks are engaging both their own employees with disabilities across the spectrum of disabilities in that training, and others from outside the bank. So I do see progress. Another question came in about, are we working with cities for financial empowerment, sometimes known by their acronym, CFE? And yes, Cities for Financial Empowerment has grown and is working in municipalities across the country. And we have helped CFE in a number of cities. We've also been able to help do outreach to bring disability-related organizations into what also CFE is been a leader in, which is the Bank On movement. And again, the interest is low-income people, including low-income people with disabilities, need to be a part of that Bank On work. And I see more groups representing people with disabilities and people with disabilities participating in those efforts. If you are connected to a City for Financial Empowerment program and the collaboration of groups and you're not getting the disability community involved, just let us know. And we'd be glad to help make introductions and make that work be as inclusive as possible. We're almost out of time. Why don't we go to the second page of questions and see if I can get one or two quickly in. Keith, I'm going to go to you quickly. Anything you can share? I know you added some things about new questions in the 2019 survey, but what may be sort of forecasting what's ahead? Obviously, you don't have the data points yet of responses, but what are you most looking forward to learning, perhaps, from some of those new questions in our that will be unveiled in 2020?
I think getting deeper insights into current bank customers. It's right that we focus on the unbanked as much as we do. It's a threshold question that the answer to which makes an incredible difference in households' ability to benefit from the economy. But as you pointed out with your access, sustainability, and growth framework, what happens when customers are in banking relationships is also incredibly important. So the questions we're adding that are helping us understand the extent to which people are, the frequency with which people are turning outside the banking system to have some of their needs met, and the questions about the satisfaction with their current banking relationships are going to provide us, a lot more information to work with to try and to understand more about those experiences, both overall and for different groups of consumers. I think, if I were to point to one thing, which is a tough choice to give me, I would say that would be the thing that would stand out as sort of the most interesting potential change that the survey can provide for us.
Great. And Nanette, I'll lower this to one research question. If you, as a researcher, could add one question we need to learn more about financial behavior of people with disabilities, what would that one question be?
How can we give you appropriate access to credit?
Access to credit, which really is the gateway to building assets, to creating your own pathway to greater financial stability. It is an area of great experimentation. Yes. As the fintechs have come in and all kinds of new thoughts, and sometimes fintechs in isolation, but many times fintechs and financial technology products being developed now within regulated financial institutions. So I certainly would agree. I think we'll close up with Keith. Any closing thoughts for the audience before I give kind of a closing comment?
Sure. Thank you. Just very briefly, I think the survey provides a basis on which to have conversations with organizations and individuals from many different perspectives. It's our hope that this survey, provides a factual grounding that enables constructive conversations. I would encourage people participate in our process. Let us know where you think we can provide improved data to support those conversations. And just thanks again for the opportunity to be here today.
Well, thank you, Keith. And then Nanette, any last thought, closing comment for our audience?
No, I look forward to seeing changes for the better in the next round of the FDIC survey.
Okay, and I know Nanette will be digging in, and we'll be looking at that data, again, comparing it from previous every 2-year period, and seeing if we're seeing some some positive changes. I think we will. And I'll leave everyone here with this single challenge, whether you are a person with a disability or you're an organization supporting people with disabilities, you represent a public agency, a financial institution, or you are a regulator. Let's do more together. Let's talk together about ways to advance opportunities for banks to better serve people with disabilities. Let's certainly bring up this challenge in terms of inclusive community development within the framework of the Community Reinvestment Act. And let's keep learning from each other. We've got a long way to go. We're making progress, but the challenges are there. They're persistent. And I think working together we'll do better. So thank you all for being with us. This webinar will be archived on the NDI website on material related to the Center for Disability Inclusive Community Development. We will begin next year with an entirely new series, a combination of webcasts and podcasts. Please download this brand new report made available today. A lot more insights, a lot more data and charts. I think you'll find it valuable. Bring it with you into discussions with your bank in your local community. Bring it into discussions at a state and national level. Much to learn, much to be gained from these insights, and most important of all, let's continue working together to advance greater financial stability and financial inclusion for people with disabilities and their families. So thank you for joining, and have a happy Thanksgiving coming up, and keep a lookout on our website for a whole series of new training and education opportunities, webcasts and podcasts next year. Thanks so much. Take care.